All right, everybody, welcome back. This is Kyle Bazzi filling in for Joe Alconin, who's sitting on a beach somewhere in Jamaica. Also here with Brianna, and a personal favorite of mine, and someone that I have looked up to since we started Benzinga many years back, Mr. Dennis Gartman of the Gartman Letter. Dennis, good morning.
Good morning. Thank you for inviting me. I appreciate it. It's a great honor.
Well, wow, what a morning to actually have you on with everything that's going on. We've been talking about Russia. We've been interest rates going to 17%. We've been talking about oil with the continued collapse, breaking through that $54 level this morning, and also China manufacturing being a little light. I'm just going to open this up right now to you and start where you're looking and what your thoughts are this morning.
Well, I think, as anybody's thoughts should be, the circumstance prevailing in Russia really has taken the center stage. I mean, the fact that we traded nearly 80 rubles to the dollar. Remember, at the start of the year, we were trading 32 rubles to the dollar. It was only 3 months ago we were trading 36 rubles to the dollar. The dollar has gone up 110% against the ruble since the start of the year. And to put that in perspective, in the foreign exchange markets, a 5% move in the course of a year is a very large move. 10% is almost unprecedented. 105%, except in the case of Zimbabwe and other reeling currency markets, such as the Deutsche Mark back in the 1930s. We have not seen anything like this in a very, very long time. And yes, Russia is small. It's only 140 million people. And yes, it is a small portion of the global economy. And yes, it really doesn't have a great deal of export trade with the rest of the world, save for crude oil. But it is Russia. It is a nuclear power. It does have Mr. Putin at the helm, who obviously is in a very uncomfortable position. And what people have not been speaking about and should have been speaking about here in the United States is the fact that the Russians have made air incursions into the Baltics over the course of the past 2 weeks, even as the economy is in a tailspin and as the ruble is collapsing. Things are a little ugly. Let us hope they don't get any uglier. Let us hope that nothing untoward happens, but one has to be prepared. The world is watching what's going on in Russia, and well, we should.
All right, so let's jump into, this comes right at a time where we start the first day of a 2-day Fed meeting. Does this change the way that they're going to approach the markets right now for the U.S.?
Well, I think that if it hadn't been for the problems in the past 36 hours in the ruble, the conversation in the meeting today and in the meeting tomorrow would have been over the rhetorical change that was going to take place. The Fed is obviously not going to tighten monetary policy, nor obviously are they going to ease. The great debate in the markets was, will the Fed remove the low for long rhetorical statement that has been part of their post-meeting communique for quite some period of time? And the answer would have been yes, that's exactly what they're going to do, probably reiterating that they are data-driven and giving themselves the ability to, after the turn of the year, and probably somewhat towards the middle of next year, begin what they call the liftoff, the tightening of monetary policy and the raising of the overnight Fed funds rate. But I do have to think, unless the FOMC members are living in a fishbowl or living in a vacuum, have to understand or have to have seen what's gone on overnight in Russia. That has to be on the table this morning sooner or later. And it probably, if anything, means that they will be less likely to tighten monetary policy as quickly as one might have said. Nonetheless, I think they will go ahead and remove the low for long conversation or rhetorical flourish that has been extant in the post-meeting communiques for a long period of time. But really, they will be discussing what's going on in Russia. If they don't, I will be very surprised. If they don't, I will be depressed.
So we have mum is the word almost for the FOMC right now, but you're saying that they're going to set up for 2015 to allow them to start to tighten that monetary policy.
Yes, if it hadn't been for what's going on in Russia, I think we were all prepared for a removal of that rhetorical statement and an expectation that probably by June or July of next year, the Fed funds rate would move up. It probably still will. Let us hope that the situation in Russia resolves itself. Let us hope that a sense of stability returns. But I have to think that the monetary authorities sitting around that great table at the Federal Reserve building today have to be discussing what's going on in Russia. They may not take it into great consideration, but certainly they're going to be debating it, and certainly it's probably given them a reason not to. If there was anybody who was going to vote in favor of tightening, that person probably is going to sit down and say, you know what, I'll be quiet for a while.
Dennis, Ron Insana has a theory on why he says the Fed may not raise rates in 2015. Do you think they should?
Not really. I think that they can go ahead and go through 2015 without doing much. I think the Fed wants to keep the yield curve as positively sloped as it can, and quite honestly, I think that the Fed would like to hold the funds rate at zero, engender a little inflationary psychology, get the gold bugs to be a little concerned, get the bond vigilantes to be a little concerned, drive rates at the long end of the curve a little higher, put a little steepening into the curve. I think the Fed would like to see that. And if you ask me, if I were a voter, although I tend to be usually hawkish on most issues, if I were a voter, I would not vote to tighten monetary policy, at least for another year.
All right, let's talk about some commodities here, Dennis. Oil obviously continuing to get to hit here right before the open. It actually got back above that 54 level, 54.50 we're seeing right now. Where do you think this is going? I mean, China on top of that added that they had weakened manufacturing numbers overnight, in addition to the Russia interest rate hike. Where do you see oil from here?
When people asked me 2 months ago where I saw oil, I said demonstrably lower. When they asked me a month ago, I said demonstrably lower. When you ask me today, I still will say demonstrably lower. I will continue to say demonstrably lower until we get such time in the futures market, and it's the futures market that will really be the best signal. I will continue to say demonstrably lower, and I have no idea how far that is. All I can tell you is it's moving from the upper left to the lower right, and until the futures market begins to show us some internal change, and that internal change will be, instead of watching the front months lose consistently relative to the back months, that is, on down days, the front months are down far more than are the deferreds, and on up days, they are up less than the deferreds. Until you see that change, until the front months begin to gain relative to the back months, my one resolute comment will be prices are heading lower. I have no idea how much farther down they will go, but I suspect they will probably go continuously lower. I made a speech a month and a half ago, actually it's 2 months ago, in Texas to a group of oil producers, E&P guys, and I told them I thought we could get to $60, and that was a shocking number even then. Mm-hmm. I didn't want to really tell them where I really thought it might go, mm-hmm. and nor will I even put that out now. I'll just simply say the trend is down, and we will be surprised by how far down prices can go. Historically, take a look at, and I know this goes back quite a ways, and some people will say it has no relevance to the modern world, but in the 1860s, crude oil traded at $3.85 a barrel. It fell to 10 cents. That's a 90% decline. Mm-hmm. Around the turn of the 20th century, crude oil got to about $13 a barrel. It fell to a dime. And what was it? 10 years ago, we got to $125 a barrel, and we fell to $10. Mm-hmm. Crude oil has this strange capability when it really gets going to fall 90% in price. History, as George Santayana tells us, those who do not learn the lessons of history are doomed to repeat it. And as Mark Twain said, history doesn't always repeat itself perfectly, but it does rhyme.
A couple of great analogies there. Are you in regards to oil, and we were talking about in 1998 when it did fall to $10 a barrel. Are there any key parts or key information that we should be looking at? Obviously, OPEC, with their announcement and information coming out in January. Is there any key indicators that you look at oil, or are you just waiting to see the actual charts make a significant bounce off of the lows, whenever that is, today, next week, next month, next year?
Again, I'll watch the term structure. I've learned over the last 25 years that the term structure tells you an awful lot about the market itself. And right now, the term structure has been moving from 4 months ago when you had WTI at a massive backwardation, the front months massively above the back months. Excuse me. There came a couple of days when on the upside, when the market was rallying, the front months began to lose. They started to fall, or I should say lost relative to the backs. And that was an anomaly. And I found that interesting. Everybody was bullish of crude oil, but yet the term structure interiorly was beginning to shift. Since then, every day, and I mean every day, with the exception of maybe 1 or 2 days along the line, we've seen the front months lose consistently. Now you're at a massive, well, I shouldn't say massive, you're at a very large contango in both Brent, WTI, and even in Dubai futures. Again, until you see the market declining and the front months begin to gain relative to the back months, I will remain materially bearish of crude oil. When the internals begin to shift, when the footprints in the sand by what I like to refer to as informed money begins to change, then I'll change. But for right now, the term structures continue to be bearish. The trend continues to be bearish. The fundamentals continue to be bearish. Rallies are to be sold. Weaknesses not to be bought.
All right, with everything going on with oil, we also had some news over in Japan with the Democratic Party of Japan blaming the poor turnout on ill weather across much of Japan for their political voting. You got to give me your thoughts on this, Dennis. I know you cover this a lot and talk about it. What do you think? What do you think is going on over there?
Well, if I were a leader of the Democratic Party of Japan, I would blame it on weather too, because clearly my campaign was an utter and complete failure. And Mr. Abe has done a much better job than people had thought. I think Abe, given the circumstances he has to deal with, where the demographics are just so egregiously against him, I think Abe has done yeoman's work. I think the DJP had no choice. They knew they might pick up 1 or 2 seats, but that was the best that was going to happen. The fact that they did pick up only a couple led them to come out and say, well, we had a very low turnout, and let's blame it on the weather that we lost. No, let's blame it on the fact that your policies are out of line, and Abe is really quite popular. So Abe has won himself at least 4 years more. Properly, he will do away with the next announced increase in the consumption tax. If there was a stupid fiscal policy put into place in the course of the last 48 months in the world, it was Japan pushing ahead with an increase in the consumption tax. In the midst of a prolonged depression, raising taxes has to be the most numbskull idea I have ever heard of. And at least with 4 more years in office, he has said he will delay the imposition of the next round of consumption tax increases. I think what he really meant to say was he's done away with them. I applaud him for that.
All right, so we have some really great questions here in the chat for you, Dennis, and that's one of the best parts about the pre-market show is the listeners actually get to engage with people like you. And this comes from one of our longtime chatters. SF Bright says, to what level? So what the Fed does is determined by what their European counterparts do. Either agree or disagree with that. And then do you see any improvement over there for this? This being a global economy, it matters so much even to what our traders are doing here and investors. Can you answer that for us?
Well, I think I understand. Reiterate the question, because I think I got a little bit confused. Is he asking me what European monetary policy has to do with domestic?
So
US monetary
domestically, do you agree that what the Fed does and is continuing to do is determined by what our European counterparts do? And then, if so,
no, I disagree with that entirely. I think the Fed is independent. I think the Fed does what the Fed thinks it needs to do. I think that if you talk to the regional presidents of the Federal Reserve Bank, whether they are voters or not voters, will tell you that, they take into consideration what's happening in Europe. They take into consideration what's happening in Asia. They take into consideration what's happening in Russia. But 80% of what they decide is predicated upon what happens here in the United States. I think the ECB takes the lead from us, not us from them. I just absolutely disagree entirely. As far as the ECB is concerned, I think Mr. Draghi has made it clear he would like to follow the U.S. quantitative easing policies. He just cannot get the Germans online. I think the Germans have made serious mistakes in being reticent to move toward quantitative easing and the purchase of sovereign debt. I think they should have started it a year ago. I think that the ECB will probably begin doing so in January or February of next year, and I will applaud them when they begin to actually do it. So no, I don't think the United States Federal Reserve Bank takes the lead from the ECB. I think the ECB takes its lead from the Federal Reserve Bank.
Great. That's an awesome answer there. And I wanted to ask you, too, about China. With the weakened manufacturing, how important is this? It's getting a little bit of coverage, but is this something that we're going to continue to see?
I find it amusing that people get excited about economic data from China as if you have any idea, or we have any idea, what the real growth rate or non-growth rate in China is. Somewhere between, Chinese GDP growth is somewhere between, pick a number, 5% and 15%, and that's the closest that you can get to it. It is a little dismaying, and the operative words here are a little. It is a little dismaying that the purchasing managers index fell a little bit. But are we surprised by it? No. Should we go out and wail and gnash our teeth by it, expecting the world to suddenly be thrown into a recession because of it? No, not really. I'm a little dismayed, but I think we'll be fine. I think that China will, 6 months from now, with the monetary policy changes that have taken place over the course of the last 2 weeks, and you can see the evidence of that in the violent upward blow up to the upside in Chinese equity prices, where capital that has been created by a central bank finds its way first before it finds its way into the broad economy, tells you that the monetary authorities are going to do everything within their power to spur growth, to make sure that GDP growth in China is in excess of 7%, and I wouldn't be surprised if it's in excess of 10% 6 months from now. So yes, the decline in the PMI is a little bit dismaying, but I'm not going to wail and gnash my teeth.
All right, to wrap up here, Dennis, you've been in the market since '74. You've been writing the Gartman Letter since '87. Just a phenomenal look and take on the markets. Tell us, I read one of your letters, I think it was yesterday's, and it said, "This is why hedgers hedge," or something like that. Talk to us just about your psyche on this market right now, as when these kind of news headlines and this type of content comes out, fear just rises up in people and we make irrational decisions. Give us some calm look at the market and how should we be thinking about all of this?
If we're talking, when you say the market, if you're talking about the stock market, let's be blunt. The trend is still from the lower left to the upper right, and it doesn't really matter, with the exception of the Russell. Whether you're looking at the Dow, whether you're looking at the S&P, whether you're looking at the NASDAQ, they continually make new highs. Trend lines have continuously held. We get a little overbought, we get a little excited, the public gets a little involved, a little over-involved, and the public has to be taken out and spanked a little bit. That's what's going on. Here at the end of the year, we're getting, with the Russian circumstance, with the collapse in oil, which at the end of, when all is said and cleared, 6 months from now, the decline in crude oil prices is going to be manifestly supportive of the U.S. economy and manifestly supportive of the global economy. But right now, for whatever reason, at the end of the year, profits are being taken, positions are being unwound, and people are going to the sidelines. I am neutral on stocks at this point, but I can tell you, take stock prices down another 3 to 4%, and I will become wildly bullish again.
All right, everyone, I just dropped the link, thegartmanletter.com, into the chat. I don't think it needs to be said, but we highly recommend you go check out what Dennis produces each and every day. Dennis, that was my question to you. How do you get all this content every single day? You're a machine.
Well, first of all, I'm proud of the fact in 26 years I've never missed a day.
Wow.
I do take Christmas off, and I do get dismayed when Christmas falls on a Saturday because it's my only day off. And even when I go on holiday, I still write the newsletter.
Unbelievable.
I've been very fortunate. It's very few people get to have a job that they cannot wait to go to work and do. I have been able to do this now for 26 years. What a blessing that is to be. I can't wait to awaken at 1 o'clock in the morning here on the East Coast and write 8 or 9 pages, hopefully cogently, sometimes with a bit of humor, as to what's going on from, as I like to say, a liberal arts perspective on the broad overview of the markets. What a great fortune that is. Thankfully, I have a great bride who's been with me for the last 25 years, who keeps me sane and runs the business. All I have to do is get up and write and share my ideas, and I am so fortunate.
Well, I just got engaged, Dennis, so I'm hoping I have found the exact same thing, which I think I have, and it's truly a pleasure and for us to help bring people like you and show just the absolute amazing insights you have on the market. Thanks so much for joining this morning.
I was honored. Thanks for calling me. Good luck. As I like to say when I sign off every day, good luck. Good trading.
All right. Dennis Gartman of thegartmanletter.com right there. Please go check out his website. Go check out his newsletter. Go check out the content he has to offer. It's truly, truly a great look at the market every day.